Yes, we are diversified in that we own multiple multifamily assets in different markets, but I wanted to diversify into a different asset class. And part of it is the fact that my husband still works full time at a W-2. So he's still in the advertising industry working for Disney. And I am not. I'm running our real estate investing business full time. Our goal, obviously, is for him to be able to join us. So to join me. So it's a lot easier to do that and replace the steady income that you have with a salary with another stream of steady income.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Christine Bellish is the co-founder of the Bellish Team, a real estate investment firm that focuses on large commercial and multifamily property acquisitions. Christine, welcome to the show.
Hey, thanks for having me.
Absolutely. Christine, there are 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start? Where are you now? And how did you get there?
Sure. So I started in the New York City corporate advertising industry. That is where I met my husband, who is my life partner, my work partner, my business partner. He is also the co-founder of the Bellish Team. We were doing well in our corporate careers, but we wanted to get off, that hamster wheel and leave the corporate rat race. And we were really looking to build more passive income. So we got started by investing in small multifamilies here in New Jersey, which anybody who's familiar with the New Jersey market knows it's not very landlord friendly, knows it's very expensive, et cetera, et cetera. Got ourselves into a couple of nightmare bird deals that we learned big lessons from, which basically brought us to where we are today, which is working in the syndication world. We are involved in much larger property acquisitions these days, 291 units. We closed in February. We're also building a net lease fund right now. So we've totally shifted gears, and I'm sure we'll jump into how we got to where we are at now. But that's the quick 1, 2, 3 on me.
I love it. That's great. Tell me this, nightmare burr deals, and I don't want to spend too much time here because I know you've probably spent already way too much time in your life thinking about this. But what were the things, high level, that you're like, man, these are the things that made this a nightmare?
Yeah. So first of all, thinking that it was a smart idea to undertake a total gut renovation as our first project. That was our first mistake. Second mistake would be not following our gut when it came to working with the contractor that we were working with. He actually came recommended from somebody that I trust the most, my dad. And yeah, so he had done a lot of work for my dad, but it was smaller projects here and there, like replacing a vanity, like, kitchen countertop or something like that. And he had all of the skills that we needed, but he really was not a business-oriented individual. He didn't care about the timeline. He didn't care about the schedule. He was kind of MIA in responding to us even before we got started on the project. And I kind of just used that as an excuse, like, that's just how contractors are. Like, it's fine as long as he's good at, what I'm hiring him to do, it's fine. But I should have seen the writing on the wall. We should have, cut the cord way sooner. And I would have hired somebody else way sooner. And I would not have taken on that level of project as my first project with no experience.
Yeah. And if you did, you'd have to do it with somebody that had that experience ahead of time.
Exactly. I wouldn't have done it on my own. I would have partnered with experts. I would have been willing to give up, half of whatever the return was going to be to partner with somebody who had more experience doing it than me, for sure.
100%. Yeah. And those are two hard lessons that we hear repeated on this show over and over, which is the first one we just covered. And then the second one is on the contractor side of things, where it's like, okay, if maybe they're good at, like you said, replacing vanities, but maybe they haven't done a project of this scope. Or maybe they're good doing, smaller projects, but then bringing on other contractors underneath them. Maybe they've never done that before. So
yes,
having that requisite experience inside of whatever the project is to say, okay, this is a good fit. So
he needed to be a sub and not a GC. Right. And we made that mistake because he was not very business oriented, meaning that he wanted to do all of the projects himself, and he didn't want to hire anybody out. And we thought that we were hiring a crew, but instead we basically hired a glorified handyman and he took 9 months to do our project. So yeah. And it's a 1,200 square foot house, just to like put things in perspective. Okay. So yeah, I definitely spent a lot of time, many tears, but we did, listen, we still own the property today. On the flip side of things, like it did end up being a good investment on paper. But yeah, I've had it with that. I'm good.
Right. So you learned some hard lessons out of that experience, but it sounds like maybe that was the catalyst.
It definitely was.
That is, said, hey, there's greener pastures elsewhere.
Yeah. So, and it's funny that you called attention to that for sure. We went to a meetup shortly, like at the tail end of that project, we went to a meetup that was in Manhattan, and it was right before the pandemic shut everything down in 2020. And it was about buying multifamily properties out of state. And we thought it was going to be buying, like a duplex or a quad or something like that, just in a more landlord-friendly state, a more affordable area where we could afford to hire a property manager and have somebody else take care of it for us. But it wasn't. It was about syndication, and that's actually where we learned about syndication. And so when they're talking about how syndication works, where you can be a passive investor, you can put money into a deal, you're an equity partner, you get all of the benefits of owning real estate, right? You still get the depreciation, you can benefit from cash flow, you can benefit from appreciation. It obviously depends on the strategy that's being implemented on that deal. But to hear that I could put money in and make a pretty awesome return for not having to do any work after just coming off of this project where I basically put my life savings on the line and bet on myself, who had zero experience, and I could trust somebody who has a decade of experience and a proven track record and, all of the connections and all of the experience to bring that to the finish line. I was just like blown away. And truthfully, like I was skeptical because I had never heard about it before. So me being the New York, New Jersey person that I am, I was like, I need to do some more research on this. I don't know why I haven't heard of this before. And if this really works the way that they say it does, then why are more people not doing this?
That's fair. Absolutely fair. It's so funny, to hear you say that in 2020 you went to a meetup and learned about syndications. And it's just a good reminder, I think, for anybody who is listening to this show, but also in the content creation space, or, because that's a common theme I hear from people is they're like, gosh, what do we talk about? It's like, I'm just reminded again from your comment there that, there's still a lot of education that can happen in this space. And I'm thinking like, gosh, anybody in real estate knows what a syndication is, right? Well, no, not necessarily. Not necessarily. So getting into it in 2020 was a great time to start investing as a passive investor in multifamily.
Yeah, exactly. And that is exactly how we got started. So we went to this meetup, and basically the keynote speakers are people who are our partners today on the GP side of things, but we started by LPing with them. So we heard about syndication. We wanted to do research about it. So, we got on Bigger Pockets. We listened to podcasts. We read books. We went to all of their webinars. We went to other people's webinars. We, interviewed previous investors who had LP'd with them. We spoke with their attorney. I read all of the legal documents. I was probably the most annoying passive investor that ever existed, honestly. But again, I selfishly was like, if this works how they say it works, I feel like this is the path for me. So I need to really educate myself about how it works. And also I had never trusted anybody else with that amount of money before, right? So if I'm going to fork over 50 grand to somebody, I want to make sure that they know what they're doing, that they have their I's dotted and their T's crossed. And so we spent about 9 months doing research and getting to know these guys and understanding syndication in general, what kind of deals are out there, how they're structured, right? Because sometimes the way that people structure deals is really complicated. There are waterfalls that are included and hurdles that you need to get over, and, split percentages and these fees and those fees. And so I wanted to get comfortable with understanding how that worked. But we took the plunge basically after 9 months, and we invested passively with these guys. And during that time, we also really wanted to pick their brains and learn from them, but we understood that these guys are super successful. They're really busy. They don't have time to just treat us like a charity case basically and teach us everything that they know, right? So we volunteered working for them basically for a year for free. So we consulted on their business for free for a year. Also, while we were spending time getting to know them, we invested with them passively. Basically, we used our marketing and advertising expertise, and we evaluated their business, and we helped them come up with a new marketing plan. Our partners are also, not from the East Coast and not from New York City. So the pace in which they do things is a little bit different than us. And so we were like, there's a lot of money in New York. And if you want to get that New York money, you need to be responsive to people now, right? So we also helped them with our investor relations strategy and hire an investor relations person for their team. So after we invested, basically a year went by, we invested with them passively a couple of times. We consulted on their business for free, built that friendship, built that trust. And then, basically a year in, I was presenting the investor relations, job role and telling them, what I think about it and who they should hire. And at the end of the conversation, I was just like, listen, we want to do what you're doing. Would you ever consider partnering with us? Can we come in on the GP side of things? What do you think about that? And they were like, absolutely, let's go. We're about to close on 291 units in Cleveland. Come with us. So that's how it happened.
That's awesome. I love that. And I love it. And that's a question somebody asked me last week. There's hey, how do, I want to get started in commercial real estate. What do I do? I was like, well, one, you're going to have to find a way to bring value to somebody else already in the space. I was like, define what your skill sets are. And, there's common roles inside of every general partnership team, no matter the asset class, common roles. And I was like, here they are. And you're going to have to figure out how to differentiate yourself and fit into one of those roles. So anyway, I won't get into all that, but I love the way you did that, which was, hey, by the way, I got an awesome background in advertising, and I can make your brand a really killer brand because it needs a refresh, by the way. But at the same time, it gave you an opportunity to learn from them. So it's that give and take there. I think that's really fascinating. You guys are doing multifamily value add, but now more specifically, we talked about this off air. You're going into multifamily development, and I think you called it redevelopment. Is that right?
Right. Yeah. So we are working on a deal soon. You know how that goes. That is basically right outside of Cleveland in an area called Rocky River, I believe it's called. It's a pretty affluent area. Basically, there is an old office building that we're going to convert to multifamily, and there's a below ground parking garage that has a ton of parking. So it's basically going to be additional income for us because obviously the residents will need a place to park, but it's way bigger than the residents would need. So our plan right now is that we're going to also rent that out to other people if they want to store, their cars there, basically.
Got it. Yeah, covered parking like that. That's hard to come by. That's really cool. One thing I wanted to circle back on, because I do want to hear more about the net lease fund. But before we get there, I had a note here that you had commented on the complicated structures that you were finding inside of deals. Have you guys moved to a much more simplified structure? And if so, what is that?
Yes, 100%. So that was part of the reason why we felt comfortable investing with our partners, because it was really easy for us to understand. And when we were looking at the underwriting and the way that it was presented, it's a straight 80-20 split for most of the deals. And so that just means 80% of all of the profits are going to the passive investors, 20% is going to the GP, depending on the deal. There's an asset management fee that's collected off of the gross rents, which basically helps pay for administrative stuff, right? Like the investor portal and QuickBooks and, keeping the lights on at the office, basically. It's minimal, right? It's 2% off of the gross collected rent. So we don't charge an acquisition fee. We don't charge a disposition fee. We're not making money on anything unless the project is making money. And so that's something that I feel really good about. It's something that I felt really good about as an LP investing with somebody, that it was that straightforward. And it works the same way when there's a capital event too, right? So if there's a refinance, basically that is counted as a repayment of principal, but we repay principal before we split any proceeds 80-20.
That's really that's really interesting that you say that, because I feel that's a conversation we're having currently on a deal that we're doing, and it's like I feel like the confused, the statement, the confused mind says no, right? And so simpler we can make this, because I'm part of both as a limited partner and a general partner, part of deals where we've set them up in that complicated structure. We're at 70-30, and then we hit a 21 IRR, then we go to 50-50, and then once there's a return, it's like, oh my gosh.
Your own accounting is harder too. Like, I'm also trying to keep it easier for myself, because like we are the ones who are calculating the distributions that we're sending to people, and I don't want to be doing all this complicated math either. For the development deals, because there's a lot more that goes into it, we usually do a 70-30 split, but again, it's a straight split. But for, the value add multifamily, or for the turnkey net lease, we're just doing straight 80-20.
Right. No, that's cool. I love that. And we are moving into a much more simplified version, just as you are, just because I think that's something, one, our investors understand, because the amount of time I spend answering questions on the water, it's like, this is dumb. Why don't we make it to where it makes sense?
Well, right. And to your point, like if that was just an easy answer, or if it was something that they could even figure out themselves, they probably would have already written the check. Like,
right.
You wouldn't be having the conversation anymore.
Right. I don't need a spreadsheet or even a calculator to figure this out. I need a back of a napkin and go, oh, okay, I understand that.
Exactly. Yep. Yep.
Let's talk net lease with the remaining time that we have here.
Sure.
You guys are doing 3, I think you said, dollar stores in a net lease fund. Why the, not left turn, but why the different asset class?
Yeah, no, it's hilarious, because all my friends and family are like, what are you doing right now? And I think the biggest misconception is that we are buying the businesses and running the businesses. So I just want to be clear about that. Like, I'm not going to be running a dollar store. Okay. I am buying the land, and I am buying the building, and the existing tenant is in place, and it happens to be a dollar store. So the reason why we pivoted is because we really want to diversify. And when I say we, I mean my husband and I, like, we personally want to diversify our own portfolio. Yes, we are diversified in that we own multiple multifamily assets in different markets, but I wanted to diversify into a different asset class. And part of it is the fact that my husband still works full-time at a W-2. So he's still in the advertising industry working for Disney, and I am not. I'm running our real estate investing business full-time. Our goal, obviously, is for him to be able to join us. So to join me. So it's a lot easier to do that and replace the steady income that you have with a salary with another stream of steady income. Anybody who's invested in multifamily, especially when we're talking about, big construction projects, and most of the stuff that we're invested in are like C and B class. So there's a heavier lift up front with that. And especially during this time right now, even still feeling the effects of COVID and, the rental assistance programs that are still in effect. And it's a little bit more challenging to get non-paying tenants out, and, supply chain issues and the cost of goods and services just being astronomically more expensive than they were before. It's a lot harder to count on reliable, steady income from multifamily. And that doesn't mean, obviously, once the assets are stabilized, it'll be a lot more steady at that point. But until we get there, it fluctuates a lot more, right? And we're paying out quarterly returns on those, and we're receiving quarterly returns on those. So with the net lease fund, we're able to offer monthly returns, because the tenants that we're targeting here are billion dollar, market cap companies. And the leases that these tenants have are corporate guaranteed leases. They're long-term. They have built-in rent increases. So it's a hedge against inflation. Net lease by nature, the landlord isn't really responsible for very much. So, if a boiler blows out, like, that's not eating into my cash flow. The tenant is paying for that. So for us, we wanted to get a stream of steady monthly cash flow, and we thought that this was a great way to do it. The other feedback that we actually received from a lot of our investors was that, a lot of them hadn't heard about syndication before. So we're talking to a lot of people that are not in the real estate game, or who are interested in getting involved in real estate investing, but to ask somebody to get involved in, a development project or even in like a heavy lift multifamily is a little bit, especially if they're not in control of the project, right, is a little bit challenging for some people to wrap their head around. So I think when we're talking about, Dollar General is your tenant and they have a corporate guaranteed lease and they pay their rent on time every single month, like on this date, and we basically have no expenses, that's a lot easier for people that are new to syndication to wrap their head around. And, it's a risk adjusted return, obviously. So we're not looking at, the big appreciation play that we would be looking at for a development deal. But a lot of people are just like looking for another source of income, especially these days with the stock market in the tank. And honestly, my husband and I have been approached to participate in other value add multifamily deals even in the past year. And the returns that we're seeing, like the projected returns that we're seeing, are just nowhere near where they were. So if I can offer a similar return, and I use the word guaranteed loosely, nothing is guaranteed. This is an investment. There's obviously risk associated with it, but I think most people would agree that something like this is a lot more guaranteed, quote unquote, than, other asset classes. So I think, those are the main reasons why we've pivoted to include that in our portfolio right now.
I love it. And there's always compelling reasons to invest in a net lease deal like this, and it's not maybe for everybody, but in the right scenarios, I think it makes a lot of sense. And especially for dollar stores, I hate to say it, but as the economy weakens or worsens, then there's the demographics that the dollar stores serve.
Yeah.
They just do better.
Yeah. I mean, we were reading stats coming out of the 2008 recession. One of the major players, I forget whether it was Family Dollar or Dollar General basically, yeah. But they were the best performing stock coming out of the 2008 recession. They were up like 60% when everybody else was crushed, right? And I just read a CNN article a couple weeks ago that was basically saying because of inflation, people that are making over $100,000 a year are shopping at dollar stores. Like everybody's just shopping, like everybody's shopping at them. So they're crushing it. So
yeah,
let's jump on the bandwagon.
Yeah, for sure. And maybe even even if it's not a bandwagon, it's still great downside protection with a stabilized cash flow. So it's like, okay, this makes a lot of sense. Certainly, for the right place in the portfolio.
Yep.
One question for you, and this is a question I've asked a lot of people who invest in a variety of net lease deals. How do you protect yourself against runaway inflation?
Right. So it's interesting because when we actually first launched the fund, we had a different strategy in mind than what we're actually doing right now. So initially, when we set out, we thought that we were going to be targeting assets that had at least 5 years on their initial lease term, which would usually mean that there's not going to be a rent bump until year 5. But the 3 deals that we're currently under contract on right now, the initial lease terms are shorter. So that means that the rent bump is coming sooner. We are also negotiating getting them at much higher cap rates than the average. So I think it's like any other asset class in that you make money when you're buying it, right? If you buy it at the right price. So I think one way that we can hedge against that is making sure that we buy it for less than the average so that when we go to sell it, we can make up, some extra money on the back ends. There are also, and this is something that I feel like isn't talked about enough, but there's this thing that's called basically blend and extend. And it's a strategy that a lot of people will use before the actual lease term comes up. And so what you do is you negotiate with Dollar General or whoever a couple years early before their lease extension is up. And maybe they had a 10% rent increase that was like written into the lease but it wasn't going to happen for like 5 years. What you can do is you can talk to them and you can say, hey, would you take a 5% rent increase and let's extend it out throughout that term? And that's basically a forced value add play at that time, right? So you might be able to get in and out of the asset a lot quicker because you're basically forcing, an increase in value by increasing the NOI at that time. So that could be an opportunity to do a cash out refinance. That could be an opportunity to sell it for significantly more than you bought it in a shorter period of time than you anticipated. So I think that there's a bunch of different ways that you can actually go about it. But one, those are a couple of the things that we're considering. And I think the fund model in general is also just beneficial because you're diversifying across, different properties that have different lengths of leases in different markets, and they're going to perform differently and they're going to come up for renewal at different times. So that balance of, maybe one lease is getting an increase next year, and then maybe the next one is getting an increase, in year 2, and then one is getting an increase in year 3. So it's a combination of those strategies.
Absolutely love it. Christine, thank you for taking the time to come on the show today and share with us your experiences so far. I've loved learning your story, how you got involved. The amount of research that you did was absolutely astounding. I mean, spending, 9 months, I think, reading and learning and going to meetups and webinars. I think it's absolutely awesome. So congrats to you and the success you guys have had so far. Certainly been a very enlightening episode. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
The best way is to follow us on Instagram. It's at the Bellish Team. You can also email me. My email is Christine@thebellishsteam, or visit us at www.thebellishsteam.com.
Fantastic. And we'll make sure we put all of that information also right there in the show notes. Thank you again, Christine. Certainly appreciate it.
Thank you.